Hello, investors. Welcome to Piper Serica's PMS and FPI fund portfolio update for the quarter ended September 2025. So happy to share with you our portfolio strategy, market outlook, as well as the return and the performance of the portfolio itself and any major changes that we have done and plan to do. So firstly, I think the last quarter was pretty tough for the Indian markets. Largely because of the tariff pressure. We saw in the last quarter the Trump administration raising tariffs generally by 25% on all exports from India, and then putting an additional 25% punitive tariff on top of that for import of crude oil from Russia. Now, both these things combined have put a lot of pressure on the Indian markets because they have led to a continuing exodus by FPIs from the Indian markets. At the same time, the domestic investors have picked up a lot of slack by continuing to invest in equity, which has been a heavily under-owned asset class in India. So where we are now is that we have the FPIs continuing to sell, no reversal in sight. At the same time, the domestic investors continuing to bring in capital, which is kind of keeping a floor and a top lid on the market. So last quarter, our benchmark Nifty TRI was down 3.2%. Our portfolio was down about 0.2%. For the last 1 year, our portfolio has again done better than Nifty, though marginally down. And if you go back since inception, we continue to be well above 18%, which is largely in our targeted return zone. What we have done in the past quarter is we have exited 2 stocks from the portfolio that you would have seen. One is a bank, small bank called Suryoday. Where looking at the recent commentary, we were not very positive that the bank is going to turn around in the near future. And the second one is our exit from CMS Infosystem, which is a stock we have held for a long time for good returns. But the recent commentary from the company shows that some of the growth triggers have gone away, at least for the short to midterm. And that is the reason that we decided to exit it, because we feel that it could drag the portfolio returns lower over the next 1 year. In their place, we have added 2 exciting stocks. Both, one of them has done very well already, called CartTrade. CartTrade is India's largest auto transactional portal and lead generation portal in the country. It has almost 80% market share in that space through its properties like Carwale, Bikewale.com. It's a complete consumer internet play. Along with that, it also owns OLX India, which is India's probably the only successful, profitable, classified and digital advertising property. Both these are very valuable properties. The company is on by itself profitable. It has about $110 million of free cash that it can use for acquisition. And we believe that in an environment where auto sales in India and consumption in India are generally picking up, this is a good long-term multi-bagger story. So that's the reason that we have added CartTrade in the portfolio. The second one we have added recently is a small cap pharmaceutical company called Senores. Now, it may seem counterintuitive that in face of the tariffs being implemented on Indian pharma companies and all pharma companies exporting to US, why do we add a pharma company? But the reason is that this is a company which is quite unique other than its products that have high value margin business. It already has a manufacturing setup in the US. So we believe that the company has good manufacturing practices, is in the right therapeutic segments, has competitive advantages that it is building on. So again, the way we look at Senores is that it is a good long-term multi-bagger story. So these are the 2 stocks that we have added in the portfolio. Our industry weightages largely continue to be what they are. We are overweight on pharma, we are overweight on EMS segment, and in the EMS segment, companies like Kane, Sirma, Amber have continued to do well for the portfolio. We have not allocated any capital, if you go back over the last 3 years, to Indian IT services. And I think this has done well for us because the whole IT services pack has been struggling and making new lows, 52-week lows almost on a daily basis. So we are pretty glad that our underweight on IT services and our underweight on large banks have played out well, because these are two segments that have underperformed the market, and we believe will continue to underperform the larger market. In terms of our portfolio direction, we continue to hold our allocations. There may be small adjustments in this current quarter, but we're not expecting any big churn to impact the portfolio. There are companies that we're always researching, and once we complete our research, we may decide to add them to the portfolio. And at that point of time, if we need to reduce allocation to some of the stocks that have done well, we will probably do that. But we will come back to you and share more details on that when we do it. Other than that, not worried about the general direction of the Indian economy and Indian growth. The recent GST cuts have already been very positive in terms of the early days of consumption, has definitely got a boost. With the tariffs, one of the benefits has been the government's focus on Make in India has picked up further, which is good for our portfolio companies. We don't have any portfolio company that right now that we can say is heavily negatively impacted by the tariffs. At the same time, we have companies that are making full use of this critical situation. So overall, the portfolio is in good shape. We are very confident that we will continue to track our 18 to 20% annual guided return guidance that we give to our investors over 3 to 5 year cycles. So thank you very much for your time, and I look forward to connecting with you again soon.